Hello, everybody. My name is Eugene Yashin, and I'm the portfolio manager here at Signet Financial Management. Today, I will update you on the stock market um, and year to date and what we see is coming later this year as well. Please take a moment and look at the disclaimers and disclosures we have for you. So today I will talk about the U.S. equity market, and we will dive into, the size and style discussion. We'll take a look at what our proprietary multi-factor macro model tells us with regards to sectors. We'll take a look at some of the factors we consider for individual securities and why we believe GARP security equities are attractive these days. We will also discuss what worked and what didn't work in our portfolios, and I will kind of highlight the changes we've made to our strategic all equity and strategic dividend equity portfolios at the last rebalancing. So far, equities have been in consolidation phase for the past few months. As you know, investors, we believe, maybe focused a little too much on politics, but we believe fundamentals are much more important. And we believe the environment remains pretty supportive for equities. We see improving earnings and profits in general. We see a modestly accelerating global world, and the economy. And the monetary policy throughout the world remains pretty much supportive for equities as well. So with regards to size and style, when we look at the value growth rotation and cycles, just to remind you, on the graph we see a 12-month moving averages between value and growth cohorts of the U.S. stock market. And everything above the red line means we're in the value regime. Everything below means we're in the growth regime. So far this year, as you can see right now, we are pretty much in the neutral zone, but just by the trend and the direction of the market, we can infer that we're entering a growth phase, and we will see more of growth being rewarded. With regards to size, the 3-year moving average cycles indicate that we're still in the slightly small cap zone. What we've seen so far this year is large cap outperforming small cap, and that's what we show on a monthly return index between large and small. So you see a little flick towards large again since the beginning of the year. But we still believe small caps have some juice in them, valuation-wise, and the growth. By judging by the growth of earnings projected by the consensus, we still believe small caps can catch up and even outperform large counterparts this year. When we look at some of the macro indicators trying to form our opinion where we are in the risk-on or risk-off environment, we all pay attention to a whole bunch, but two very important ones are credit spreads and yield curve slope. Judging by credit spreads, when credit spreads are low, it means we're in the bullish environment, and we are. Judging by them, they are the historic lows, as you can see, and that's a blue line on the chart. When we look at the yield curve, ideally we would prefer yield curve to be with a higher slope, meaning the market believes there's going to be more growth in the future. Right now we see yield curves pretty flat and flattening, but we believe that's a product of the Federal Reserve, increasing short-term interest rates, and the slope is artificially low. as I mentioned before, we do have a proprietary multi-factor macro model where we look at a whole bunch of indicators and form our opinion on which sector is going to outperform the broader market over the next 12 months and which will underperform. And judging by our forecast, we have industrial, materials, technology, financials, and real estate are poised to outperform the broader market. And on the other spectrum, consumer staples, telecom, and energy are forecasted to underperform the market. And as you can see, most of the sectors in green are cyclical, pro-growth sectors, and most of the sectors in red are pretty much defensive sectors. This chart shows pretty much the same information, but in more details with regards to how the forecast pertaining to each individual sector changes and has been changing over the last 12 months. As you can see, financials with a flick here still look pretty stable. Real estate has been improving. Industrials have been pretty solid. Technology and materials are also solid. And the biggest change we see in telecom, switching from, real dark green to pretty reddish here. So I also would like to point out that consumer staples and utilities, both pretty defensive sectors, are forecasted to underperform the market, which is also a bullish sign. So at this point, we do favor GARP stocks with some pockets of value in few sectors like financials, for example. So GARP are the growth at reasonable price stocks. So we see market start paying more attention towards how the companies grow their earnings and sales, and also how profitable the companies are. We still believe companies can manage to keep and maintain their margins due to continuous globalization. And the proof of our, belief is the earnings last quarter. They jumped 13.9%, which is also a very good sign for equities. A few words on the factors. So we also, we have macro models looking top down. We also have micro models looking bottom up. And we've got hundreds of factors describing each individual company. And we've got 3,400 companies we'll look at and combine information on. This is a very concise heat map on a few factors. So in green we see the value group. In orange we see the growth factors. In blue we see profitability and quality, and in yellow we see safety factors. So, and what we depict below in the table, we take the first two quantiles of our stock universe consisting of 3,400 stocks. And we take the average performance of the first two quantiles per each individual factor, and we compare it to the average of the universe. And as you can see, current PE, price to book, price to sales, those are value indicators, have turned from green at the end of last year to sharp red at the beginning of this year, which tells us that the market starts paying less and less attention to valuations. The earnings growth and the sales growth is turning from red to green, which means the market starts paying more attention to growth. The same is working for profitability and quality, operating profit margin, return on equity, return on assets is turning green lately. And safety, becomes again the priority, as you can see, and safety was turned completely off at the last quarter. of last year and at the beginning of this year. But this is a pretty intriguing development as well. So what worked and what didn't in our portfolios? Our biggest contributors to the bottom line are information technology and healthcare. And our detractors, so to speak, are financials and consumer discretionary. And what I would like to talk about here is that we still believe financials are unjustifiably undermined in the market. We believe financials will be much more profitable, especially since interest rates will hopefully go up pretty soon. And also consumer discretionary, we believe the market is too cautious with regards to consumer discretionary. We see more and more, the job market looks great. The low-paying jobs, the growth of salaries within low-paying jobs has been on the rise over the last 15 to 20 months. And what we see with regards to consumer discretionary is the propensity to consume among the low-paying, people tend to be much higher than those who get paid more. So we see more and more consumption towards discretionaries as well. So the changes we've made to our strategical equity portfolio were pretty minor. We still, we're moving towards more of a mid cap, but we still believe, as I said before, that small caps should catch up later this year. As I said, we're moving towards GARP, growth at reasonable price stocks, and we overweight IT, industrials, financials, and materials. Really nothing much changed in the portfolio. We kind of swapped Chemical Financial Corporation for Bank of America in financials, and we replaced Chicago Bridge with the LKQ Group. So not a huge change in the portfolio, and we had to trim Applied Materials because the stock has appreciated so much. And this is our posture in strategical equity portfolio. As you can see, IT, financials, healthcare, industrials, and consumer discretionary are the sectors we overweight, with less so in consumer discretionary, and we actually overweight in materials as well. The changes to strategic dividend equity portfolio were also pretty small. We kept large cap posture. We stayed the value course to really secure the dividend in the portfolio, and we overweight in industrials, materials, and we're trying to close the gap in financials. So we sold Kinder Morgan and PNC, and bought BGC, P Group, and BlackRock. Again, the posturing in strategic dividend equity portfolio is pretty value-oriented, with financials, industrials, information technology, healthcare and energy, and utilities being the largest sectors. But as you can see, utilities are overweight in the portfolio due to high dividends they pay. So that's pretty much it. This was our stock market update presentation. And if you have any questions, please do not hesitate to send me an email at iyashin@signetfinancialmanagement.com. Have a wonderful afternoon. Goodbye.